Good afternoon and welcome. My name is Steve Jewell with CommunityGiving, and we're really excited to have you with us for today's webinar on impact investing. This is a topic that we've wanted to explore in greater depth for some time, and we were just so pleased that each of today's speakers has made time on their schedule available so that they could be here with us to talk about this topic, which there's a lot of interest in this topic and basically people trying to do good with the resources they have, whether it be a foundation that holds an endowment or whether it's individual investors or donors who have contributed dollars. How can those dollars have an impact beyond just being given away, but how can they be invested for impact? So today's format is going to be pretty simple. We're going to feature our primary speaker initially, Susan Hammel, and then followed by that, we will have a panel of representing three different entities that CommunityGiving has made impact investments in. And so we're excited that all three of those panelists could be with us today and talk about that. If you have questions, we are going to get to questions. Just put them in the Q&A tab or in the chat, and we will get to them as we have time. And we do have a time allotted for questions. So please, as we go forward, just put your questions in the chat or in the Q&A tab. And with that, I'd like to get right into the introduction of our speaker. Susan Hammel with Cogent Consulting. As a philosophy major who went to Wall Street, Susan Hammel translates between passionate social change makers and expert accountants. In her role as founder of Cogent Consulting, which is a public benefit corporation, Susan is serving her 6th year as the Minnesota Council on Foundations Executive in Residence for Impact Investing. She designed and launched the Minnesota Impact Investing Collaborative, which is over $115 million in assets. She and the team at MCF also created and launched the Integrated Capital Recovery Program, raising $44.7 million in direct response to the COVID-19 crisis and racial unrest in the summer of 2020. Susan and the Cogent team advise philanthropic institutional investors around the country on impact investing, from strategy to policy development to due diligence. The team also advises select innovative social entrepreneurs seeking to raise impact capital. Best known for their work mapping the Twin Cities impact investing ecosystem, the team continues to engage fellow practitioners to address the gaps and promote practical solutions. Susan has served as the executive director of the Delta Dental of Minnesota Foundation and CFO for Ashoka, Innovators for the Public in Washington, D.C. She obtained her master's in public policy from Harvard, is a chartered financial analyst, and graduated cum laude from Carleton College in Northfield, Minnesota. She has an extensive background and experience serving on boards, currently serving as the chair of the Fresh Energy Board Finance and Audit Committee, member of the Carleton College Careers Advisory Board, member of the Trillium Family Foundation Board, president of the Minnesota Alumni Network of Harvard Women, and prior chair of the Citizens League and NPH USA. A lifelong lover of water, both liquid and frozen, Susan and her family reside in Deep Haven, a lakeside community outside Minneapolis, where she enjoys sailboat racing, paddleboarding, and skiing. And with that, please join me in welcoming today's speaker, Susan Hammel.
Thank you so much, Steve. I appreciate that wonderful introduction. I'm so happy to be here today. And, talking with professionals about impact investing is one of my favorite things to do. I'm going to keep this interactive. We're going to have polls, we're going to have quizzes, but no grades, I promise. And really eager for your questions in the chat. I already see some of them coming in, so thank you so much for that. I do know we have a mixed audience today of professional advisors who work with donors who might come to you for financial advice or philanthropic advice. I know we have foundation trustees, staff, and other stakeholders. So we will definitely cover content that's applicable to all of you. So our goals for today, we've got 5 goals we're going to cover in this segment of today's webinar. Number one, to gain a common understanding of impact investing. At the end of this webinar, I want you all to be able to go home and explain to your partner, your spouse, your 9-year-old daughter or son, what impact investing is. Secondly, really understand the way that foundations and high net worth individuals are engaging in impact investing. 3 is to understand some examples. We're going to do some theory, but we're going to keep it real and talk about actual examples in our communities. And then view the impact investing process, and we'll just see how much time we have to get into those kind of implementation questions. Like I said, we're going to have various polls, quizzes throughout. So keep your eyes on the screen and keep peeled for those polls. We're going to have some check-ins so that you definitely will achieve your educational goals for today. And I do need your help. If I'm using jargon, please do put that into the Q&A in the chat as well. You could request that I go back, but really vocabulary, there are some new vocabulary here, so do let me know if you'd like more explanation. Steve already mentioned Cogent Consulting. We're a team. I'm so pleased to have Danielle here today. I will say in terms of water, Danielle's works with us remotely from Miami. I imagine the water down there is quite liquid. The water here in Minnesota, Danielle, is very much frozen. So we're just delighted to be here with you today. Steve already described who I am. I think the only thing I would add to that extensive bio is that I'm also a proud part-time resident of Greater Minnesota. We have a little family home down in southeastern Minnesota, south of Red Wing. So very, very excited to be with you all. Okay, impact investing. What in the world is it? It is an alphabet salad or an alphabet soup. Your clients, donors, individuals may call it all sorts of different terms: sustainable investing, socially responsible investing, triple bottom line investing, double bottom line investing. Your corporations, businesses might call it corporate social responsibility. There's just so many different terms, and that can be paralyzing for a lot of people to then turn to action. So how can we make sense of this? How can we move through this alphabet salad? Well, this slide, the investing spectrum, is something we're going to come back to again and again in our time together today. And it really is how you look at investing for foundations, but also for individuals. So we'll go through each part of this investment spectrum and talk through some examples. So the first thing on the left-hand side are grants, right? So whether you're a donor or you're a foundation, or you advise foundations or donors, really it's clear that a whole bunch of foundations give about 5% of their assets annually for charitable causes. They hope to make a positive impact, and the return, the financial return, is negative on purpose. It's 100% loss on purpose. So that's really charitable giving. I think we're pretty familiar with that. And that really is the public face for a foundation. It's the public face for individuals. Sometimes some individuals and foundations choose to remain anonymous, but these are just some examples of foundations in our state that have done, really significant grants all around our region. The Blandon Foundation, McKnight, St. Paul, Minnesota Foundation, and what they publicize is really their grants. On the other end of the spectrum, of the investing spectrum, you have traditional investing. And often this is called the other 95% when it comes to a foundation, that they are giving away the 5% for grants, and then this is the other 95%. For individuals, it may be more that they're getting a tax deduction for 5% on the grant side, and then this is their 95%. Traditional investing is really just looking to get that financial return that sustains the foundation and its grant making, or for individuals that sustains someone's retirement or someone's business. So it really is just looking for that financial return. So here we'll do a quick poll. First of all, and I'll ask Abby to help me out here, but we want to get a sense of really who's in the room. We want to know if you work on the grant making part of your foundation's activities, and you can just say yes or no. Question 2, do you work on the investment part of your foundation's activities, yes or no? Or if you're an independent advisor, do you advise nonprofits, for-profits, or individuals on investments? Or if you're an advisor, question 4, do you advise your clients on gifting as well as on investing? We'll give you a few minutes here. And Abby, I'll look to you when it's time to announce the results of the poll.
Looks like there's still some coming in, so we'll give it a little bit more time.
Absolutely, take your time.
All right, it looks like it's slowed up, so I'm going to go ahead and end the poll. And share the results.
Fantastic, thank you so much, Abby. So it's really a mixed group, which is fairly typical in these kinds of situations. But really it's people who really work on the investment side, which is not a surprise that are here. About on a foundation level, about 35% are on the investment side, 65% more on the other side. And for independent advisors, they really are on more the charitable side. So this is really helpful to see, and it's good to know kind of who's in the room. So thank you for that. Moving back to this investment spectrum that we're gonna keep keying onto the investment spectrum. So we've covered grants over on the left. So the negative financial return, the positive measurable impact on the left, and on the right, the traditional investing. And that's really the mainstream, how most people think about charitable giving and investing. So what's changing is everything in the middle of this spectrum. And I'm going to cover each tab: venture, philanthropy, impact investing, and responsible investing, because that's where all the change is happening. So let's start with responsible investing. This is investing that really is looking for that financial return to sustain the foundation in its grant making, or to sustain an individual's portfolio. If they have a donor advised fund, they might be looking to grow their portfolio. So responsible investing is all about that market rate financial return. In responsible investing, what's different from traditional investing is investors add a values lens. And the values-based screen could be positive screens, which are typically called ESG, environmental, social, governance screens. This topic of ESG investing is getting a lot of attention right now, and I'll go into it in a little more detail in just a couple of slides. Other clients or foundations may have a geographic screen. They may say they really want their investments to be focused on the Midwest, for example, or the United States. Or they might say, actually, we want our investments to be in northern Minnesota. So people can get very specific, even down to a city level with their geographic preferences. Other screens that have come up lately are getting diverse asset managers. So really giving a shot, giving a chance to asset managers who are not the typical asset managers. The typical asset managers are, they tend to be white male-led firms. And then the other investment managers that aren't as typical in many portfolios are led by women and people of color. So many foundations in particular are adding on a diverse asset manager screen. Divestment is also part of a screen. We call that negative screening as opposed to positive screening. Negative screening can be everything from the old sin stocks, screening those out, to screening out fossil fuels. We'll go into a little bit of that in the next slide. But this is responsible investing helps investors achieve their philanthropic mission more effectively. And responsible investing has been around an awfully long time. In fact, we trace it back to Martin Luther with the common chest in the city of Wittenberg in 1523, when he put the chest in the church and said, hey, if you need to build a school or build a home or start a business, we're just gonna have money in this chest. You come on in and get the money you need, build your school, and then put it back when you're done. It's kind of a very early example of impact investing. And really the origins of this whole movement came from values. You'll see the picture of the Quakers there on the slide. In the United States, it really did start with the Quakers and then the Shaker movement, religious people who really felt they only wanted to do business with people who shared their values. Fast forward, lending circles really became popular in the 19th century. They are now all over the world, in Asia and Latin America. They're very popular lending circles. And then this socially responsible investing movement reemerged in the 70s with the environmental movement, and then in the 80s with the divestment movement from South Africa, the movement to end apartheid. And really, this is when the investment industry writ large stood up and took notice that this movement to divest all investments from South Africa at the time is credited with helping to end apartheid, not by itself, but it was a significant piece. And that's when the mainstream investment industry said, okay, this can actually work. Amy Domini launched the Domini 400 social index back in the 90s, and it's still in existence, has a different name now. So this SRI movement, socially responsible investing, has been around for at least, active for 50 years. In the recent years, there's fossil fuel activism, the Dakota Access Pipeline, university endowments are getting a lot of pressure from students and other stakeholders, donors, to divest. But this is really about investor pressure. And that's all part of responsible investing. So what does this look like today? Many investors are moving past the old divestment movements and really moving into the positive screens, talking about what we want to invest in rather than what we don't want to invest in. And that's where this ESG, environmental social governance criteria, come into play. In fact, as a CFA, chartered financial analyst, we are required as analysts to review all material ESG factors when analyzing a stock. So this is really morphed from being values related to being just about measuring risk. So there are many analysts now at investment houses who do an ESG assessment of a company. They look at financial assessment, they look at risk, they look at the ESG actions, the corporate social responsibility, and they're really looking the environmental impact of the product, the creating the product, and the business operations. So they're looking at the environmental piece. The S, the social impact of the product and the business operations, has to do with how they treat their employees. It has to do with your supply chain. Some apparel companies have gotten into trouble for having in their supply chain suppliers who actually use child labor in their practices. So the S has become really important in this last year in particular. And then the G, the governance practices, or about how well the company is actually governed in terms of the board and the CEO. So really there's the negative screening, what we won't fund. Then there's the positive investments, the ESG. The third way that responsible investing is practiced today is with shareholder advocacy. And this is where shareholders use their voice as owners of companies to advocate for the causes that they believe in. This ESG type investing has exploded in the last few years. And it's now over $12 trillion in assets under management by US investment funds that use ESG factors. So this kind of investing, responsible investing, has really gone mainstream. So now that we've covered grants on the left and traditional investing on the right, we've now covered responsible investing, which is market rate of return with the values alignment, do no harm kind of principles. Let's turn back to the left side of the spectrum. So what's happening with grants? Grants are changing. Grants are starting to morph more into venture philanthropy. Venture philanthropy can be both a 100% loss, just like a grant, but it also can be below market rate impact investing. Venture philanthropy really grew out of the experience that many tech executives had in the early part of the 2000s of great success growing and scaling big ideas that turned into huge companies. And they said, we did that well, why don't we apply that to our charitable goals, to our philanthropic goals? So let's develop cross-sector partnerships with visionary leaders. Let's help them grow and scale. And let's be like venture capitalists, but with philanthropy. So let's work in the trenches with the partners instead of just making a grant, actually join staff meetings, sit on the board, bring expertise and influence to the organization, including opening up your Rolodex. The other principle of venture philanthropy is investing in the long term. So many grants are short term. Venture philanthropists are there for the long term, just like a venture capitalist who we're going to hear from later today. So it's taking that same mentality of bringing in advisors, leveraging knowledge and networks. It's doing that whole approach, but doing it with philanthropy. So what does that mean? Well, this is an example from one of our clients in Philadelphia. It's called the Ujima Developers. And it's a real estate and development collaborative that promotes the economic health and wellness of residents in communities. And they've launched this project called the STEAMY Project, and it's going to be a workspace and living space and incubator in an area of Philadelphia that's pretty hard hit by both the pandemic and the racial reckoning and the economic factors prior to these events. So this is an example where foundations and individuals came together to support the Ujima project. And they really, besides opening up their wallets, they really opened up their networks and they opened up their Rolodex and they got engaged and they really worked side by side with the developer to say, what do you need? What do you need to make this project work? And what resulted was going back to that spectrum, right, were grants for the Ujima project, but also some below market rate loans to help make this project happen. So venture philanthropy is just a different way of achieving philanthropic goals. So I want to do another poll to check in for understanding. I've covered a lot of material in a pretty short amount of time. So Abby, back to you to help me with this next check-in for understanding.
All right, here we go.
Okay, so another pop quiz here. Number one is are you clear on what responsible investing is? Do you know what ESG is? Do you understand venture philanthropy? And do you think investing for impact is some kind of new fad? So this is all yes or no. We'll give you some time to think about your answers.
All right, looks like it's slowed up. I'm going to go ahead and end the poll. And here are the results.
Thank you so much, Abby. So everyone's got responsible investing. That's, you guys all understand that, 96%. ESG, you're good with that. You've also heard about that, 88%. Venture philanthropy, 84%, very good. That's kind of a new one. And then do you think it's a new fad? That was kind of a trick question. No, it's not. So thank you very much for that. And I do want to, I guess we're going to do questions at the end, but I do want to acknowledge a question about venture philanthropy and about how they geared towards profitability or ROI. That's a great question. So we'll get to that at the end for sure if we have time. Okay, moving on. Let's go back to our key slide here, the investing spectrum. Okay, so now we're going to talk about impact investing. Impact investing is an investment that seeks to create a positive financial return that is actively measured and monitored. So just going back, I want to emphasize, this is not grant making. This has to be better than 100% loss. This definitely is an investment. It can be market rate and it can be below market rate. And defining that is a bit in the eye of the beholder, but we'll get into some of those nuances in just a minute. Impact investing also needs to be measured. The social impact needs to be measured with at least as much seriousness as the financial return. The market has just exploded recently. This is from the Global Impact Investing Network. And they're up to 404 billion in assets under management. That our slide's a little bit old here, but it's even, I think it's doubled since then. So this is a really popular field. I guess the people who feel like this could be a fad might be a little bit right about this. Investors include funds, they include foundations, banks, family offices, pension funds, insurance companies. Corporations have recently entered the market, as well as community foundations. In fact, in the last year, just anecdotally, our firm has gotten many inquiries from community foundations looking how to do impact investment. The market is global in scale. There's a lot happening with impact investors interested in Africa, for example. And actually that was more active before the US caught on to the topic. And the leading sectors have been financial services, clean energy, microfinance, housing. I saw the question in the chat about housing. Food and ag, infrastructure, and health are really some of the hot sectors in the impact investing market. The whole point of impact investing is that there is an intention to get this financial return and the philanthropic mission. So it's using assets, that 95%, to generate impact that is tied to mission. We'll go through some more examples. The other piece I wanted to share with you first, so is the roles a foundation can play in impact investing, since some of you may have foundation clients or be a trustee or work at a foundation. I would also add that donors and high net worth individuals can play different roles in impact investing. We've talked about the role they can play as an investor. That's pretty clear. But let's say someone's not quite ready to be an investor yet. You can be a capacity builder, can do a grant, can provide technical assistance, investment capital to a nonprofit. We're going to hear this afternoon from a wonderful nonprofit I've been following for years, Propel. They're a nonprofit organization called a CDFI, Community Development Financial Institution. So for anyone who's not sure where to get started, that's a great way to get started in impact investing. Even with a grant to a nonprofit like Propel, your donors will learn a lot by being a grantee, by being a grantor to an organization like that. Another role that a foundation can play is a partner. So let's say you're not so sure about impact investing, but there are others who are very active in impact investing. You can piggyback on their work and partner with them. Foundations can engage networks and audiences. Community foundations like the session today are very good places to play the engager role and the informer role. So let's talk about another example. This is an example from Moorhead, just a little bit north of where you guys are. So the Fargo Moorhead Area Foundation made a $100,000 loan to help the Lakes and Prairies Community Action Partnership expand and purchase a building in South Moorhead to be used for a variety of programs and really an extension to their existing services. So this is an example of what the Fargo Moorhead viewed as more of a market rate impact investment. And the idea was to make an impact in the community by taking a portion of assets typically invested in Wall Street and invest it right here at home and make a meaningful difference in the community. So this is their idea, was this is where Wall Street meets Main Street. And they're still working on mission related investing, creating a revolving pool to do this kind of work. Back to the spectrum. So market rate investing or mission related investments, MRI, are on this right-hand side of our spectrum. We also call this aligned investing, aligning your investments with your values. So it can be that responsible investing, that ESG, or it can be impact investing, which could be market rate or program related investments. You guys all know what responsible investing is, so we don't have to spend more time on that. So let's talk about MRI. MRIs tend to be capital market investments with a market rate or better return, that there is a social and environmental benefit that aligns with the goals set by the foundation or the donor, and it meets ESG expectations as well. In our work in Minnesota, we've been lucky enough to get to know the folks at Great North Capital a little bit, and we would categorize them as an example of an MRI, so a market rate impact investment. The other piece I'd just like to say about MRIs is this is not a defined term in the tax code. This is not a defined term anywhere. So if someone is using this term, it's always good to ask them what they mean, because they might mean something completely different than you think. But we view it's a market rate impact investment. So let's do another poll to see how we're doing on understanding. And thank you, Abby, again for your help with that.
Here we go.
All right, so question number 1, do you have a better understanding of impact investing? Yes or no? Number 2, do you know how impact investing is different than responsible investing? Number 3, do you believe that impact investments are all below market rate? And 4, do you know what MRIs and PRIs are? Yes and no to each.
A few more seconds. They seem to be trickling in yet.
Absolutely.
All right, I'm going to go ahead and end the poll. And here you go.
Great, thank you. Okay, so we have nailed it. People have a better understanding of impact investing. Kind of know the difference with responsible investing. They got the trick question right. Not all impact investments are below market rate. We busted that myth today. And we're getting into MRI, PRI, which was a bit of a trick question as well, because we haven't covered PRIs too much yet. And then you've learned that there are ways that foundations can engage. So great, going well so far. So let's now turn to these PRIs. PRIs fall on the spectrum of impact investing right here on that line. They can be a tool for venture philanthropy, but they are also impact investments. And they are on this left-hand side of the spectrum with a below market rate of return. PRIs are actually a defined term in the IRS tax code, section 4944C. So for private foundations, there are a lot of rules about program-related investments. For community foundations, they do have a benefit, but they're not as tightly defined in the tax code. They just have to be reported on in a community foundation's tax return. So what are program-related investments? Typically, they're below market rate loans made for a charitable purpose. So for example, a program-related investment would be a low interest rate loan into a nonprofit like Propel, or like another community development financial institution or another nonprofit. That's very frequently what they are. However, they don't have to be loans. They could be equity investments, guarantees. There's all sorts of structures they could actually take. So for the public foundations, we hit that it's going to be in the tax form, but it's not defined as it is for private foundations. They earn a below market rate. That's the big rule for private foundations, is that they have to be done with a primarily charitable intent. So it's called the charitable purpose test, where the primary purpose is to accomplish one or more of the organization's exempt purposes. The second test, and this again only applies to the private foundations, is the below market rate test, that the production of income or appreciation of property is not a significant purpose of the investment. So you're primarily doing it for charitable reasons, or you wouldn't do it if not for that charitable purpose. Number three is it can't be political. So those are the three rules for program-related investments, defined term since the 60s in the tax code. Let's talk through an example. So in St. Paul, the St. Paul, Minnesota Foundation was faced with the loss of jobs in the East Metro in 2007 and 8. And they wanted to do something about it. But for a foundation, it's a little hard to work with business. I mean, how do you do that? Are you going to give a bunch of grants to for-profit businesses? That doesn't feel quite right. So what are you going to do? So they decided to address the job loss, that it was small business that really are the ones who create jobs. And so they identified community development financial institutions who make direct loans into small businesses in the East Metro, with a priority on women-led and people of color-led businesses. They resulted in a $2.1 million East Metro Job Creation Loan Fund that continues to revolve and pay back. So they're working with MEDA and NDC, two great CDFIs in Minnesota, and they've made they've actually done a lot of work on the impact of this fund and the jobs and the number of loans made. So this is an example of a type of below market rate loan that achieves a philanthropic purpose. Another famous example of a program-related investment is actually the Pfizer Shot. The vaccine came out of a program-related investment that the Gates Foundation made to the biotech, the German company that partnered with Pfizer on the vaccine. Now, they didn't do it for COVID. It was a couple of years before COVID, but the Gates Foundation had a charitable purpose of investing in researched diseases and interventions for those diseases. And so they made a grant to this company for that purpose, or not a grant, a program-related investment. When COVID hit, the company pivoted and applied their technology to COVID. So now that program-related investment that the Gates Foundation made for charitable intent has actually made a lot of money for the Gates Foundation, which is actually allowed under the tax code, as long as your foundation documents that your primary intention was charitable. It's okay if it ends up making money, which is always a good thing. And then you can do more with your charitable mission. So let's throw in another poll to see how we're doing, because we covered some technical jargon there.
All right, here we go.
Abby, number 3. So yes or no questions. Must a foundation make a program-related investment to a nonprofit? Number 2, does this still hold true if a program-related investment ends up being highly profitable? 3, if a PRI is only broadly related to your mission, does that suffice as a charitable intent? I'll give everyone a few minutes here.
They're still coming in.
Great.
I give it about 10 more seconds here. All right, I'm going to go ahead and end the poll. And here are your results.
Thank you so much, Abby. Okay, so people pretty much understand that a PRI actually can, looks like my sharing paused there really quickly. Okay, a foundation can make a program-related investment to a for-profit. That is actually allowed under the tax code definition, and it is a great way for a foundation to engage with a for-profit, since making a grant to a for-profit creates additional paperwork, and some foundations don't even allow it. Number 2, what if the PRI is profitable? It's okay. The Pfizer Shot example. There are others, particularly with donors, with donor advised funds, who've invested in startup companies for a mission-related purpose that end up doing really well. And then their DAF gets really big overnight. Sometimes that happens, like with Beyond Meat was a famous example of that. Number 3, if a PRI is only broadly related to your mission, does that suffice as a charitable intent? Yes, you guys got that right. Also a bit of a quick trick question. A PRI doesn't have to be tied to each like grant making priority or each philanthropic objective of a donor. It just has to have a broad charitable intent, however you define that and however you document that if you're a private foundation. So let's give a chance here to just pause and add some questions that you have to the chat. I do want to, just kind of address some of the questions we already have, but I would like this to get a sense of where you're at, to pick one of these 3. I have a few questions. This is new to me, but I think I'm getting it, or no questions. Let's keep going.
I'll give it about 10 more seconds. They're slowly coming in yet.
Great, thanks, Abby.
All right, I'm going to go ahead and end the poll. There we are.
All right, thank you so much. So it's pretty much most people are like, it's new to me, but I'm getting it. And then no question, let's keep going. So we are going to keep going on to implementation. But first, I did want to just answer some of the questions in the Q&A so far, and feel free to put some more in there too. So we got an example about the St. Paul, we got a question about the St. Paul Foundation. Example creates a mission purpose, but I'm not understanding where returns are generated to repay the loan. Okay, so here's how it works. The St. Paul Foundation made a loan, a below market rate loan to these two nonprofit entities, NDC and MEDA, which are both community development financial institutions. NDC and MEDA then takes that loan from the St. Paul, Minnesota Foundation, and they use that capital to loan to small businesses in the East Metro defined priorities of the St. Paul, Minnesota Foundation. Those small businesses pay back those loans to NDC and to MEDA. And when the small business pays back the loan, then these organizations are able to pay back the St. Paul Foundation. And the way it's structured is it's not like every time a small business pays back a loan, they pay back the St. Paul Foundation. There's an actual loan agreement between the St. Paul Foundation and these nonprofit groups. And there's a time and period when they have to pay it back. So the nonprofits just have to be really sure that they can make those payments on the schedule. And one way they do that is the St. Paul Foundation actually reached out to some colleagues and peers in the area, the Northwest Area Foundation, who made a grant to these nonprofits so that they were able to have money for loan loss reserve, technical assistance, and outreach. So it actually is a great way to think about impact investing, is to combine it, do both a grant and a loan. And that's called integrated capital, to throw another term at you. So thank you for those questions. Another question we had right at the beginning was about housing, where to invest for the creation of affordable housing. So that's a great question. Affordable housing is a great opportunity to do impact investing. And we have some great projects in Minnesota where you can get involved. So for example, you can work with a nonprofit affordable housing developer like an Aon, or you can invest in a fund that invests in affordable housing. Steve mentioned at the beginning of the webinar about the Minnesota Impact Investing Initiative, MI3 for short. That is actually a market rate impact investment example that I'll go into a little bit, but it really is about affordable housing. So there's more questions coming in, which is fantastic. So I'll answer one more, and then I want to keep going so we make sure we cover the implementation questions here for you today. So one question we got was about venture philanthropy. So venture capitalists want this profitability and the ROI. How does that mesh with nonprofits? And how do venture philanthropists measure ROI? Great question. Thank you for that. So you're right. Some market rate impact investors are venture capitalists, and they want their return on investment to be market rate. And then they also want what they call a social return on investment. So they may require or ask the entity they're investing in to show the social return on investment. They might, if it's affordable housing, for example, they might want to know the number of units and who was helped and what happened with those people. If it's into businesses, they might want to know how many jobs, what is the pay, what is the retention rate, are these companies staying in Minnesota? So we have on our panel this afternoon, we have Granite Equity. And so that's an example where someone with a market rate impact investment point of view would also look at the retention of jobs and economic development Minnesota, just like with Great North focus on Minnesota. All right, I'm going to keep going. I know there's other questions, and we'll try to cover those at the end. So let's talk about implementation, because your clients may start asking you, or as donors, you might want to know, gee, how do I get going doing this? This all sounds great. So one thing I want to urge you to think about are the stages of engagement by foundations and by high net worth individuals. So we've seen people and organizations move through these 4 stages. Sometimes it takes several years to move through these stages. More recently, we've seen people take 1 year to move from stage 1 to stage 3. So it all depends on your organization, but it starts with curiosity. So there are a lot of people who've heard this alphabet soup of socially responsible investing, impact investing, and they want to know more. And they might have opinions about it, and they might believe some myths about it. So who's engaged in that curious stage? Many Mission Investors Exchange members. That's a national association of mission investors. I highly recommend. And we see a lot of companies in this stage. Stage 2, the learning stage you're in. These are people who want to learn more, and they tend to be a lot of high net worth individuals who have heard about responsible investing, ESG investing, and now they want to do something more local or more bespoke or something more specific to their interests. We're seeing many family foundations and high net worth individuals at this stage 2. Stage 3 is really when folks get strategic. And this is where we're seeing the community foundations enter the fray, where they really are knowledgeable and a little bit experienced with impact investment. Maybe they've made a couple, but now they want to get strategic and really tie their impact investments to a defined strategy that their donors can get behind. And stage 4 is all in. This is where people and foundations decide that they want all of their assets, all of their invested assets, the 95%, they want it all aligned with mission. We mainly see private foundations do this. McKnight Foundation is there. We have other family foundations like the Mortensen Family Foundation has made this a goal. They're at about 60% on the way to all in. But many individuals also have decided they want to be all in and are investing in that way. So how do you get started? Well, the first thing is some policy guidance. Whether you're an individual looking to start or an institution, maybe start with something easy like geography. Is that a passion for you? Is that important for your foundation? I think of the Bush Foundation, which is focused on our region, Minnesota, North Dakota, South Dakota, and the 23 tribal nations that share that geography. So is geography important to you? Maybe it's not, though. Maybe it could be an internationally diversified portfolio of impact investments. That's okay, too. Second thing to start looking at are values. What values are going to help define these investment choices? You can look at your own funding priorities, your own philanthropic priorities for ideas. You can review the mission of your organization or your philanthropic mission. And then you can look at what your leadership, your board, if you have one, wants. But also, I'd really urge you to think about input from the community. Steve mentioned I'm on the board of the Trillium Family Foundation, and we're engaged in a learning journey to find out what the community actually wants. These are different ways to get started with your values to translate into your investment choices. And the third thing to think about is risk. What level of risk is acceptable? Would you like a diversified portfolio of impact investments or just a less diversified? Do you want what about volatility, liquidity? How do you want to balance financial return and impact? The question we had in the chat. Are you willing to give up some financial return if you're going to get a social return? These are all questions where there's really no right or wrong answer. This is up to you, your organization, and your own priorities. As a family, this would be a kind of fun exercise to go through to really ask yourselves. So thinking about values and geography, one tool we found to be really helpful is this concept of an impact bullseye. And here's an example from the Kresge Foundation. So instead of thinking only of the bullseye, which is a direct, alignment with Kresge program strategies, or if you were an individual investor, this might be your favorite and most important charitable goals, right? Think of it a little more broadly. So if you go out to the next circle, this is instead of direct alignment, with the programs, there's an alignment with the mission. In this case, it was advancing opportunity for low-income people in cities. So that would still be on the board, It's just not a bullseye, but it's still on the board as a concentric ring. And then there's an outside ring that's more the alignment with the field. So it aligns with ESG, responsible investing. So let's say you're a geographic investor. You could say my bullseye is St. Cloud, Minnesota, but I'm willing to think more regionally. I'm willing to think about the whole state of Minnesota. And then I'm willing to think even broader about the region, the Midwest. So you could think about it geographically in a geographic way, or you could think of values and which ones are core, that would be that bullseye, but which ones are pretty close. And this is an approach you can take to really choosing your investment strategy. Now, if you are a foundation, a lot of things change inside a foundation once you start impact investing. Your board might become more engaged. New staff roles emerge. There's new interaction between the grant making staff and the investment staff. And often there's a new committee formed. So, and it's a steep learning curve. This can change for a family. This can change for an individual. For an individual, it's a little easier if they don't have a board and committees. So this is really relevant for what happens inside a foundation. So now you're probably thinking, this sounds hard to get started. This is a section on implementation, right? It doesn't have to be hard. I'm going to give 2 examples of different types of impact investments. So one is a program-related investment, below market rate impact investing. And the easy button for program-related investing is an organization called the Venn Foundation, which is headquartered here in Minnesota and run by Jeff Oakes. So he's created a way for anyone to get involved in program-related investing, whether you're an individual or a company or a nonprofit, a foundation. You can open up what's called a Venn account, which can be a donation or it can be a program-related investment to the Venn Foundation. And you can they then make the impact investments for you. So it's a way to kind of get started as the easy button for, especially for donor advised funds. As another example of impact investing, but on that market rate side, you have the Minnesota Impact Investing Initiative. And this goes to the question about housing. Economic development and affordable housing is what this fund is backing. It's a market rate fund. For those of you financial advisors with access to investment options, this is actually managed by RBC. It's called RBC Access, and it is a publicly traded mutual fund. And we've created a Minnesota sleeve of this national mutual fund. So the great thing for investors is you get to invest in this mutual fund, designate your money to stay here in Minnesota, but you still get the benefit of the national diversified pool. This fund actually buys market rate, AAA rated government-backed securities backed by mainly affordable housing projects. And as investors, you can choose which counties in Minnesota you want your money invested in. So you could pick one county or you can pick them all. So this is an example of this market rate impact investing and a way to get started. So let's go on to I think this is our last poll here before we get to this fantastic panel we have this afternoon.
All right.
So, okay. So just practical considerations for you. And do you think this sounds doable as a pilot program, or you're excited, or you're going to proceed slowly? So really practical considerations for you. And if you could just pick one, like this sounds doable, I can get going at least to start, or I'm excited to see what's next, or we're not so sure. So 3 options.
Still floating in. I'll give it about 10 more seconds.
Great, thank you, Abby.
Okay, I'm going to go ahead and end the poll. And here are your results.
Thank you so much, Abby. So it sounds doable. It's about 20%. About half of you are excited to see what's next. And about a third are like, we're going to go slow, which that makes total sense. So other topics I want to hit very quickly before we go to that Q&A is just emphasizing that these conversations can be difficult between staff and board of a foundation, or between family members, or between individuals who have a financial advisor and a philanthropic advisor, where there might be different levels of financial expertise, different norms of confidentiality and prudence. There's this investment committee fiduciary duty culture, which is different than the philanthropic charitable culture. And in general, just talking about money is hard for people. So this can be difficult. And what we do recommend people do start with their investment advisor who can help guide these conversations. The steps to an investment decision for impact investing are: first, you got to find them, which we call sourcing. Second, you do an initial review. Does this meet our charitable goals? Does it meet some financial goals? Then you do a deeper dive into the impact. And then you do the risk assessment and the financial analysis. So it really is similar to any investment process. And we have a question in the chat about how bankers can underwrite this kind of work. You know what? You can use your same way you would underwrite any other deal. You just need to add this impact piece. And for that, you could rely on people in your bank's community benefits department or in your foundation. They could help you with the impact review. The risk assessment and the financial analysis, the same. You just want to point out, the risks and know what the risk tolerance is going in. This is another example of the Cleveland Foundation of how to kind of tie it all together for you guys, especially as a community foundation, where they created a social impact investing program that went all the way from those grants all the way to the SRI, social responsible investment pool. So you got on your left side the grants, and then the right side your investments. And you have different return expectations. For the grants or recoverable grant, which is a grant that gets paid back, there's 0% interest, there's no interest, right? And then there's a market rate return for their socially responsible pool. I like these examples because it shows the source of the funding, the term, the eligible recipients, and the definition. The recoverable grants are these grants that come back. So I know I've hit you with a lot of information in a fairly short amount of time. Before we get to our panel, I do want to give you a call to action to learn. You're here today, which is great. Keep learning. Number 2 call to action is connect. Connect with others who are exploring impact investing. Start with your financial advisor. Ask your family members. Connect with other people in the community giving community. And then 3, commit. You can go ahead and start somehow. Maybe it's a grant into a nonprofit doing impact investing. Maybe it's a program related investment, or maybe you want to try your hand with a market rate investment. There are a lot of options right here in Minnesota. You're going to hear from several in just a few minutes. But really, the problems that our society and challenges our society faces really need all of us to think about all of our assets in this different way. So I'll stop there and hope we reach the goals for today. Do ask for feedback in the chat and vocabulary that's new for you. And then I guess back to you, Steve, if there is time for questions and any you'd like me to address.
Thanks so much, Susan. And we're going to turn it over to, this is just fantastic. We're going to turn it over to Elise, who's going to introduce our panel, and then we'll have everybody back for more questions. Okay? Thanks. Elise?
Thank you, Susan. Truly a wealth of information about a continually emerging investment arena, for sure. Before we get to the Q&A, we wanted to showcase 3 organizations that focus on impact investment and are included in Community Giving's socially responsible and impact investment pool. We have Propel Nonprofits, Granite Partners, and Great North Ventures. So first, Garrett Backus is the development director at Propel Nonprofits and works with foundations, businesses, and individuals in leveraging philanthropic support. Garrett, please describe the work of Propel for us.
Thanks, Elise, and hello, everyone. So nice to be here with you today, and I appreciate being able to highlight our work. And thank you to Susan for the very kind words earlier about the work of Propel. I'm going to share with you our presentation here. So I'm going to do a screen share. See if this works. And I will share just a little bit more with you about Propel Nonprofits and what it is that we do. And I'll get a little bit into specific to impact investing as well, how we've been able, one example of how we've been able to leverage that. So Propel Nonprofits, we are based here in Minnesota, in Minneapolis. Our mission is to fuel the effectiveness of nonprofits with guidance, expertise, and capital. That's in service to our vision of a diverse network of mission-driven nonprofits building a healthy, vibrant, and more just community. We're an intermediary and federally certified CDFI, and we provide capacity building services and capital access program supporting nonprofits in achieving their mission work. Our focus in our programs and services is on nonprofit finance, strategy, and governance. We work with nonprofits throughout Minnesota, as well as the bordering states and neighboring communities around there. We really run the gamut as far as the types of nonprofits that we support: healthcare, housing, arts and culture, human services, environment, you can see, and much more. And we support nonprofits throughout their life cycles. A little bit about our services. I'll just breeze over these and just give you a sense of the depth and the breadth of the work that Propel does with nonprofits. We have a few accounting and finance staff that have an expertise in that area, helping nonprofits with managing their accounting data and building financial leadership, confidence, and expertise for nonprofit staff. I'll talk a little bit more about this later in my example, but we have a loan fund, about $34 million. And from that, we make loans exclusively to nonprofits to strengthen and expand their programs, manage cash flow shortages in times of distress, as well as finance real estate projects and capital campaigns. We have a few consultants on staff that do strategic consulting. That runs the gamut from strategic planning to board development, really getting hands-on with nonprofit board members and building their expertise and know-how in navigating difficult issues. That's especially been important the past couple of years with the stress and strain that communities have felt through the pandemic and unrest. And then we also have other strategic consulting services around leadership transitions and helping organizations smoothly do that, as well as other strategic supports. We do a wide variety of trainings, and those are both public as well as customized. They can be as short as 1 hour. Our training team also does some cohorts, so building financial leadership in nonprofit leaders, where it's several months. It's a group of people together, nonprofit leaders learning about how to build their financial leadership strength and capabilities. We offer technical assistance to really anyone, any nonprofit that calls with questions big and small. It's entirely free, and our staff are all available to help nonprofits either get unstuck or learn what it is you don't know what you don't know. So helping nonprofit leaders and staff learn about finance strategy and governance and kind of navigating issues that may pop up. And then also a wide variety of skill and knowledge sharing. We have a really robust set of resources and tools on our website, some long-standing and some that have just been added in the past year or two around navigating the pandemic, the Paycheck Protection Program, all of those things that have arisen. And so it's there, available, again, free for nonprofits. We serve as a launch pad for new and emerging nonprofits. So this gets back to that across the life cycle. Our fiscal sponsorship program is a great way for emerging organizations, people with passion and ideas, and how to best serve community needs that are emerging. Propel serves as their fiscal host, and we do the background work and help build their infrastructure, as well as their business model and planning for sustainability as they eventually gain independence and their 501c3 status. A few other services here: Board Connector, getting board members that are passionate about community connected with nonprofit board governance and leadership positions, as well as our leaders circles. This has really something of great value for leaders, especially navigating through, again, these past few years and really stressful and trying times, both in community as well as operationally for organizations, both small and large, across various service areas. That peer coaching, support, and learning those leader circles. So now I'm going to get into how Propel leverages impact investing, and talk a little bit about our loan program, and then give you an example coming up here. So our loans, they provide patient, affordable, flexible capital to nonprofits. The value that Propel adds is that we are able to take on some higher risk and fill in the gap as lending partners. We work very closely with other banks as some of these projects are funded by multiple sources. We often act as the key, or kind of the core anchor to that project, and being able to provide intensive TA to the technical assistance to the nonprofits, which it really works well from the bank's perspective as well, that we're able to come in with that expertise and support. So there you go, around technical assistance, financial planning, and mentorship. And then this is just an example of in our current fiscal year, just around leveraging support. We've deployed $8 million in loans and leveraged an additional 12 externally, making for $20 million in nonprofit capital project impact. Another nice thing about the investing in Propel's loan fund is we can recycle capital that has been invested, so we can consecutively support many projects. And one example is in partnership with CommunityGiving. They generously gave us a $200,000 loan back in 2017. And it's currently invested in the Three Rivers Montessori School. And they're doing a capital project, a building purchase and rehab project. And so we, along with a portion from CommunityGiving, brought in other funding sources as well for this. I believe it's a $2.3 million total project. And so we filled a few financial gap, as well as a nonprofit expertise partner on it to help make this project possible. And they are based in Elk River. Before this project, that $200K, we invested that, and it's gone to support 3 other nonprofit organizations, and those are Great River Faith in Action, United Cerebral Palsy, and Art and Science Academy, which is in Santee. And I believe that Cerebral Palsy is St. Cloud, and Great River Faith in Action's in Becker. So you get a sense of the impact in this region through that impact investing. That's all I have. I'd be glad to, I'm gonna jump off here, but I'll make room for the other panelists and take any questions in the Q&A later. Thank you.
Thank you, Garrett. Next we have Shelley Bowerly-Copel, who is a partner at Granite Partners and leads their governing activities. As stewards in creating outstanding value for members, Granite Partners believes in impact beyond returns. So Shelley, I'll turn it over to you to describe this impact.
Thank you so much, Elise. And thank you to Susan and Steve and the rest of the team. It is a pleasure to be with you today. First, by way of introduction, Granite Partners is a private investment and holding company with a mission to grow companies and create value for all stakeholders. We talk about being trusted partners, innovative leaders, and responsible stewards. And we are committed to 100-year sustainability. We aspire to world-class well-being for all people in and around the Granite community. The Granite companies, including 10 of them today, are private, established, profitable, and growing companies. They are niche leaders and have strong roots in Minnesota and serve national and global markets. When we think about the Granite community, we think about various stakeholders, and I'll talk about a few today. They include the entrepreneurs or business owners, the leaders in the Granite companies, team members or employees, advisors, and members in Granite or the investors. The Granite community is growing value for all stakeholders. First, from a performance perspective, each year we compare the Granite funds against several industry benchmarks using various time horizons. The benchmarks we utilize are the Total Bond Index Fund, the Real Estate Investment Trust Index, Berkshire Hathaway, the S&P 500, the Total Stock Market Index, Small Cap Index, and the US Private Equity Buyout Index. You'll see on this slide that as we assess performance across these 7 benchmarks and across the time periods shown in the chart, the Granite funds show consistency and persistence. The green indicates areas of outperformance, and the red indicates periods of trailing that particular benchmark. So for example, Granite has outperformed the benchmarks in the 3, 5, 10, 15, and the 19 years since inception periods. You'll see in the 1-year horizon, given strong performance in the stock market, that the Granite funds were slightly below a few of those benchmarks. But overall, the funds have outperformed in 46 of these 49 performance measurements. Specifically then, as we look at impact, we take a broad view of that word. As we collectively work to grow the Granite companies, we seek to expand the positive economic and social impact these companies have in local communities. And I'd like to share a few examples today. One of our sources of pride is the jobs that we create in the Granite companies to sustain and create those jobs. You'll see in this data, in the chart here, that we have secured over 2,300 jobs over these years through new platforms that we've invested in and their respective add-on acquisitions. In addition, and importantly, we have created an additional 800 jobs on top of that through organic growth. You'll notice that in every year we have grown net jobs. But beyond the quantity or number of jobs, we do focus on providing quality jobs and on safeguarding and enhancing employee health and well-being. We work to expand and enhance benefits for all team members, and a few of those examples are shown on this slide. I'd like to just name a few that are beyond traditional or usual benefit offerings, and those include a college savings program, a discretionary profit sharing program, volunteer time off, and a variety of well-being programs and well-being coaching, among other examples. As you might imagine, safeguarding, protecting, and enhancing employee health and well-being is particularly important today. And we have collaborated across the Granite companies and spent time, energy, and resources to keep team members safe during the pandemic. This slide is an example of a variety of practices that we put into place to safeguard employee health during the pandemic. Another particular example of a benefit to enhance financial well-being of team members is the Granite Retirement Savings Plan. And you'll see on this slide that it has grown significantly and is a real source of benefit for team members. Additionally, we have recently added a series of financial benefits in the past 2 years in particular to support team members. These include financial planning, financial counseling, and emergency assistance. And I'd like to call out the Emergency Assistance Fund. This supports eligible employees of the Granite companies during times of significant hardship. And this has been particularly important these past 2 years. This is one example of our partnership with the Central Minnesota Community Foundation, and we are grateful for that. In addition, we track a variety of impact metrics each year, and we share our progress on these important metrics in our impact report. These include metrics on gender inclusion, ethnic and racial diversity, mentoring and leadership development, leadership placement, and retention, to name a few of the metrics. In terms of community impact, United Way is a focus area across the Granite companies, and we strive to increase the numbers of leaders in giving, employee participation, corporate match, and total investment each and every year. We also offer paid time off for volunteering for team members to engage in and support their communities. Granite Charitable is one of the more recent innovations at Granite Partners. It is an innovative structure for administering donated Granite units. We incorporated Granite Charitable in 2018, and we thank CommunityGiving and the Central Minnesota Community Foundation for their management and administrative services for Granite Charitable. Through Granite Charitable, Granite members can donate Granite units to support their community and various nonprofits' interests while still sustaining Granite Partners. Granite Partners and Granite members have donated units from the Granite funds, and with the new units donated every year plus growth on those units, the current value is approximately $16 million as of 2021. A few of the designated beneficiaries of Granite Charitable are shown on the right side of this slide, including the funding of the Granite Emergency Assistance Fund and the Granite Educational Scholarship Fund that I mentioned earlier. In addition, a series of nonprofits and educational institutions have directly benefited from this work, as well as donor-advised funds. And then, as you know, various nonprofit organizations thus benefit across a wide variety of efforts in education, environment, faith, diversity, inclusion, poverty, public safety, and so on. By way of another specific example, the Women's Fund of the Central Minnesota Community Foundation is a significant beneficiary of Granite Charitable. And the Women's Fund mission is to strengthen communities by improving the lives of women and girls. Both Granite Partners and the Women's Fund are deeply committed to the importance of inclusion and belonging. More broadly, we measure sustainability as the combination of business impact and business duration, creating high cumulative impact across 100 plus years, that objective that I mentioned earlier. Additionally, we have a sustainability affinity. It's a group of leaders across the Granite companies to help guide our focus areas. We measure and advance the 5 mutually reinforcing dimensions of impact, including economic, social, community, governance, and environmental. We recently conducted a survey, and leaders across the Granite companies identified environmental stewardship as an area to invest more time and resources into. And so that is a current focus area and collaboration in the near term. We strive to continually advance this work, measuring value and making an impact. To close then, I want to, on behalf of Granite Partners, express gratitude for our partnership with CommunityGiving and the Central Minnesota Community Foundation. And thank you to Susan and the other panelists. Thank you, Elise. And it was very fun to join you today, and I'm happy to take questions later as well.
Thank you, Shelley. And finally, we have Ryan Weber, who is managing partner and co-founder of Great North Ventures. Great North works with tech startups to build and scale their businesses. Ryan, help us understand Great North's focus on providing impact opportunities.
Thanks, Elise. share my screen here. Hi, everybody. I'm Ryan Weber with Great North Ventures, managing partner based out of St. Cloud, Minnesota. Great North Ventures is an early stage venture fund in venture studio that's led by and supported by founders who have scaled tech companies or operated tech products in corporate innovation roles for larger corporations. So it's a network-driven strategy. We try to leverage people with experience scaling these high-growth tech startups or tech businesses to support the next high-growth tech startups in our region. So it's that place orientation that came up earlier from Susan. The fund invests in early stage startups, really the earliest stage that most VCs will participate. It's is typically called seed financing. So, and with our regional focus, we intentionally invest more heavy in Minnesota and neighboring states, and are intentional about focusing on greater Minnesota and developing capacity for more startups, where we've been lacking as of recent years. We're now investing out of our second fund. So in fund one, we invested in 27 companies between late 2017 and last year. We're now investing out of our second fund. Fund one was 23.7 million. Fund two is still open, but we'll invest in 25 companies with an initial check size of $250,000 to $1 million. So in today's presentation, I'm going to share a little bit more about the importance of venture investing to supporting economic development efforts in our state and country, but especially with emphasis in greater Minnesota. Then I'm going to speak a little bit about the metrics we're measuring for impact, and how some of the partnerships that we formed that are having an impact. So first, on a macro basis, the pace of change is accelerating with accelerating change through tech proliferation, digital transformation. So since 2000, 52% of companies that were on the Fortune 500 went bankrupt or were acquired or ceased to exist, is attributed by Harvard Business Review, primarily due to digital disruption. Adaptability is key to success. So my background was in product and innovation. And so the style of product innovation in tech that has become popular is a very adaptive style for innovation, because you have to continually redefine how you compete in the market. And so that's the type of businesses that thrive in this environment. And so we need to build capacity within our businesses and in the region to continue to develop that adaptability and strengthen, both from the startups, but also the corporate innovation will benefit from that as well to preserve, our strength economically. And the data shows the regions around the world with the lowest unemployment rate tend to be the regions that have the highest, the most advanced technological capabilities. And if you look at the impact of venture-backed companies, currently it's significant, even though only 0.2% of our GDP is venture capital. It's driving, the companies that are venture-backed are driving 21% of all US GDP. So it's very significant. And we have a gap. So historically, the big three cities, New York, led by Silicon Valley, in New York and Boston, they have captured the majority of venture capital dollars, more than 70%. And so Minnesota in the Midwest is now ranking typically actually number two out of the six, in the top 6 of the middle 25 states as kind of a rising community, with 1% of first venture financings occurring in the Twin Cities in recent years. So 1% of the US's new venture funded companies, first venture funded companies, are occurring in the Twin Cities. When I pulled some data on the number from PitchBook, the leading private financing, probably data source. And when we look at the data, it's for the outstate next tier cities, we can see there's very limited number of new venture financings occurring in our smaller, in the next tier cities in Minnesota. And so there was, during the same period, there were 39 in the Twin Cities. We had 1 in Duluth, 4 in Rochester, 1 in St. Cloud, 0 in Mankato. So when I look at on a per capita basis during this period, if we compare these cities to the Twin Cities, Rochester is outperforming the Twin Cities on a per capita basis by over 200%, largely driven by Rochester, Mayo. But Mankato is at 0% efficiency, St. Cloud 50%, and Duluth at 37%. So the Twin Cities isn't the leading, performing startup center in the country on a per capita, but it's rising and performing reasonably well. But we definitely have are lagging, in greater Minnesota. And in Minnesota, for venture capital, VCs in general are biased towards their backyard. So we do have, you may have heard of, there's a number of fund managers and newer funds that exist and have existed in Minnesota. But one of the other challenges we have in the funds in Minnesota have the lowest local loyalty rate. So most of the companies, only 30% of the companies that venture funds during this, as reported in this report by Crunchbase, only 30% of the companies that were reported had only 30% of the companies invested in were Minnesota-based companies for the funds during the reported period from Crunchbase in Minnesota, which is the worst in the Midwest for loyalty, meaning our funds have not historically been investing in companies that are based in Minnesota. They've been investing in companies based in other markets. So we started our fund as a network, focused fund because we saw a lot of opportunity having scaled a tech startup here in St. Cloud to 170 employees on little capital. We saw an opportunity with the growing momentum in the region and all of the talent to invest in greater supporting the capacity of startup entrepreneurship in the region, led by a heavy concentration in Minnesota, followed by nearby states. And so in Fund 1, we made our last new investment last year. So 15 of our first 27 investments were in Minnesota companies. And in a survey of entrepreneurs, we were the most recommended fund for rounds under $2 million out of 64 early stage capital sources they could choose from. And we think the reason for that is our fund, again, it's not just our partners, but we have over 50 advisors that can contribute their expertise to helping support the startup entrepreneur in supporting, guiding them through operational and strategic matters that come up in growing these types of businesses. And these are the kind of businesses, if you think about like Google, in 10 years, they went to 3,000 employees, but in 20 years, they went to 200,000 employees. So these are kind of the really high growth type companies that we're backing. We're already seeing some evidence of that in our early, we started investing in late 2017. Our average hold is 25 months. And these were companies that had mostly just launched their product. And we're already seeing quite a few jobs, being employed by the portfolio. So in greater Minnesota, the first 2 investments we made in greater Minnesota was in Zenlord Pro out of St. Cloud and IRA Logics with operations in greater Brainerd. So you can see some of the data here on our investment activity. And the other, we led more than 50% of the investments that were made by our fund. And so the further you get as a company, capital tends to travel, further to find you. And so we've been able to bring in capital through our relationships with other venture funds to quite a significant level. As you can see here, in total, our 15.5 million of invested capital, we were able to attract 700, quite a bit more capital in co-investments, so 762 million through the companies since our initial investments. And when you look at a lot of economic policy is driven on, creating, bringing a company in or creating, for adding jobs to a community. When we look at our updated performance, for every dollar we invested, the companies have produced a new, one job for every $17,939 of Great North dollars deployed. So typically, Tim Bartek, senior economist with the Upjohn Institute, specified that public incentives are typically closer to $50,000 per new job. So venture capital applied with a market, rate kind of lens can be very efficient way of with these high growth companies to create an impact in these communities. With our second fund, besides investing, we're also incubating startups. And so we made 5 investments out of Fund 2. 2 of them are in companies we helped incubate. And so both of these companies are in Greater Minnesota. NextGem was started in Grand Rapids, Minnesota. And Backhouse Brands was started in St. Cloud and Mankato. So these 2 companies will have invested by the end of, we've already invested, as you can see here, $825,000, and we plan to invest another $475,000 this year for a total of $1.3 million into the 2 companies. And so these are companies that we got involved in from the conception stage, the idea stage, leveraging our background as operators to work with new management teams selected to work on these 2 opportunities and help them work through the innovation process and then building the MVP and attracting capital. So with the fund, besides our investments, we try to be very active as in the community to support building startup capacity. And so we've been very active working with Launch Minnesota. This has started since we first began the fund. Neela Mulgard is executive director. They have hub partners across the state in every region. There's 8 regional partners, as you probably heard about. Launch Minnesota has really helped us to engage at broader, geographic region in Minnesota. That the greater Minnesota markets were very difficult to navigate when you wanted to make an investment and track the startup opportunities, which are often hard to find, hard to identify. And so it's been very exciting to work with the different hub leaders and participate in pitch events that they're organizing, virtual and online, as well as conferences and so forth. One of the other key initiatives for our fund, when we started the fund, we started an initiative to build startup education capacity in our region. We saw a lack of disciplined startup entrepreneurship skills or innovation skills for identifying and researching new business models. And so we had trained over 200 participants through our workshops in Minnesota, predating ILT Academy, and then through a collaboration with Neela Mulgard while she was at Red Wing Ignite, we received grant. We were able to apply and were awarded grant funding that allowed us to put an RFP out and hire dedicated staff to start ILT Academy. ILT Academy last year had 183 people graduate from its lean startup programming. And so now it's expanding. This year, our fund made it. So besides investing, I'm mentioning some of these initiatives. In Fund 1, we contributed 1,800 hours of volunteer time and $300,000 of capital from the GP's, management entity to supporting building startup capacity in our region with an emphasis on greater Minnesota. And so just last night, we actually hosted an event with ILT at a new startup space in St. Cloud on a historic building, the Davidson Opera House. Founders drove from all over outstate Minnesota to participate and be able to network with ecosystem leaders and investors. So with ILT Academy, now, having, being able to thrive with enough capital to kind of sustain itself, from an education initiative, we're able to leverage that as a pipeline for new investment opportunities. And this year, we're excited with the progress they made their first year and a half with ILT. We made a financial sponsorship to match any regional partner in Launch Minnesota that sponsors an ILT program. And then lastly, we organized a new Greater Minnesota Angel Investing Group. And so we have participants all across the state to support fostering improved collaboration and deal flow, which had been lacking in recent years, I think, in Greater Minnesota. And, one thing why this is important. So our second fund, we've raised now in half the time, 40% more capital than we did in Fund 1. It'll be announced sometime later this year when we make our final close, how much it is. We're we actively share co-investment opportunities, as you can see, with other angel investors and as well as other funds. So investors in our funds are sometimes, as I mentioned, investing directly into the startups as well. So it allows us to kind of create an opportunity for us to we'll lead and do the heavy due diligence work and support. But for investors that are interested in supporting these types of companies, there's co-investment opportunities, that are shared through our angel group or through the fund's marketing materials. One thing in Minnesota, this is not the state probably that's the easiest to get a venture fund started. All of the nearby states have fund-to-fund programs that are state sponsored, including in Illinois, a $1.3 billion fund-to-fund. We have $0 in Minnesota state money supporting venture fund, investing in venture funds. So we do have the ability to deliver market returns. We think we and other funds are showing with a regional focus. We're really excited by our progress with the startups in Fund One, and I'm very optimistic. I think the state is making it a priority, and it's great to see. But we still have, I think, so are other states in the region, and so it's important, I think, to continue to invest in venture-backed startups for the reasons I mentioned earlier. So that's all I have. Ryan at greatnorthventures.com is my email. Look forward to connecting with you all, and take other questions later. I really appreciate CommunityGiving's work and Cogent. They've been very helpful in great partners in the communities that we serve, and also understanding our role as it relates to impact investing. So thank you all for the opportunity today. And
Thank you, Ryan. And thank you all for sharing your work in impact investing. Obviously, there are diversified opportunities for supporting social good in our communities. And now we have a little time for some questions. I will turn it over to Kai Tran, Executive Director of the Community Foundation for Carver County. Kai?
Thanks, Elise. Thanks to all of our speakers. We've got quite a number of questions here in the chat, so we will get right to it. First one is for Ryan. Can you expound on the due diligence process when selecting an impact investment? What is different and what might be the same as a traditional investment?
yeah, it's a good question. I think, in angel investing in general, we had a track record of 11 years prior to the fund investing our own capital into startups. And so through both launching products in our own operating business and investing, we kind of honed our investment process over time. But typically, we have a set of criteria we look for. It's really evaluating the team, the traction, and we call product market fit, which is essentially how close are they to being able to show they can repeatedly, profitably scale distribution, with their business. And then we look at their market. Is this market big enough to support, a venture like, returns? And so for the investment process, there's a lot of money in the, that is investing, following funds into deals. You have to be careful with that. If you're not doing your due diligence, you run the risk of, potentially, whatever mistakes that were made. So typically what happens in venture is right now what's happening a lot more frequently. Angel investors can do this, but it can be very time consuming. We average on a check even a size of $250,000, we're typically spending 50 to 100 hours in due diligence. So we share our due diligence with when we can be helpful for co-investment. And so what's happening is a lot of angel investors are joining angel groups or investing in early stage funds as one way of kind of collaborating and sharing some of that diligence work or responsibility. But different types of startups have different different investment criteria. I'm also a member of Gopher Angels and have been since almost inception. So I've learned from a lot of great angel investors who invest. We're primarily investing in software technology companies. So I think there's other processes, but it's also very stage specific. So the level of diligence, if you use a late stage, like Granite does exceptional diligence, I'm sure. I'm a big fan of theirs, but it's a different process. But just like anything, the more you do it, you get better at it. And so we kind of have different things we're looking for at different stages of development.
Well, great. Thanks for that, Ryan. Next question is for Shelley. How does this type of work support community-based nonprofits?
So if I understand the question correctly, in thinking about ways to benefit or impact those nonprofits in the communities in which, for example, for us, the Granite companies work, a variety of examples there include those, the nonprofit examples of the United Way, or for us, Granite Charitable is, our primary vehicle to go out either directly to nonprofits in the communities or to donor advised funds. Then that particular donor then has a whole variety of nonprofits that might benefit across communities. So I think there's a lot of different ways that could be answered, but those are a few examples.
Thanks, Shelley. Next question is for Garrett. What are reliable indicators of what an impact investment might make good sense for donors or clients?
Yeah, I can't as much speak to the financial aspects of it, but definitely the mission perspective. I think considering what their charitable goals are and what their values are, and then going from there. So thinking about what they have available financially and how they might want to leverage that impact to support their community, support their region, or a specific cause. So that's kind of where I always come back to, whether it's a charitable giving decision or looking at the impact investing opportunity, PRIs, MRIs, is kind of doing some self-reflection first, and then just having an awareness, whether that's through partners with financial advisors, foundations, et cetera, of getting connected with organizations that carry out your passions through their missions in the community.
Thanks, Garrett. And then we've got 2 questions for you, Susan. First one is, are there opportunities for ex-bankers to practice impact investing?
Yes, absolutely. There's a great need for ex-bankers in impact investing. One way to get involved would be to join the investment committee of a CDFI, a community development financial institution, such as Propel or any of the others. We have 35 certified development financial institutions in Minnesota, so you should be able to find one near you that you like. I think the other piece is if you are a trustee or on the board of a foundation, or you could offer your services to do due diligence. As Ryan said, that can be quite time consuming. He said, about 50 to 100 hours. It also is sometimes a missing expertise. So you and your 5 C's, the 5 credit, could be very valuable. And the third way is to do it yourself. There's opportunity zone investments that you can make. That would be more market rate investing. There's the Venn account option we mentioned. And then there's the RBC Access, different types of impact investing that's available publicly.
And then the next question is, would a modified rate of return be a better gauge of profitability than an ROI?
Excellent question. And the short answer is yes. A modified rate of return that would be, I would modify it by your expectations of liquidity, of your expectations of volatility. There was an early question in the chat about affordable housing. That is a very stable asset class, very stable investment. It can be a good addition to the diversification of your financial portfolio because it's such a stable asset. So there, a modified rate of return would be helpful, but also say that the lower the rate of return you as an investor are requiring of a nonprofit in particular, sometimes the more impact they can have. That doesn't apply so much to the Granite equities in the great norths of the world, but to a nonprofit that can make a huge difference, the rate of return you expect as an investor.
Well, thanks, Susan, and to all of the panelists as well. I'm going to turn it over to my cohort here, Greta, to do the wrap up.
Thanks, Kai. I'd like to say thank you to all of our speakers, Susan Hammel of Cogent Consulting, Garrett Backus of Propel Nonprofits, Shelley Bowerly-Copel of Granite Partners, and Ryan Weber of Great North Ventures. What an amazing, amazing webinar we've had today. We really appreciate all you've done. We encourage you to reach out to your local executive directors with any questions, comments, or feedback. That would be Carl Samp in Brainerd, Kai Tran in Carver County, Sarah Carlson in Wilmer, myself in Central Minnesota. We are all here to help and answer any questions or provide or take your feedback. Just a quick reminder, our additional resources are available on our website, including the recording of today's webinar and past webinars. And our next webinar will be May 5th, focusing on alternative gifts such as crypto and real estate. Thank you so much for your time today and for attending. Have a wonderful day. Thank you.